Good afternoon, and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle.
John, I'm happy to be here.
I'm glad you're here one more time to enlighten us.
Well, I don't know about enlighten, but I'm here.
Well, the big issue this week has been taxes. In fact, clients have been calling our team with service requests every day to make sure cash is in the bank to pay taxes that are due today.
Too bad you don't get paid on interest while it's sitting there.
So while coronavirus cases have spiked the last few weeks, deaths have been fairly stable. And it will be interesting to learn from you today the reasons for the continued low deaths and how our hospital systems are managing with the rise in infections. But the big question is going to be, to what extent will schools across the country open, and what impact will this have on the recovery? And another thing is that despite the negative news that we hear from mainstream media, the market continues to inch up. There are bright spots that we can point to in the economy.
Climbing that wall of worry.
So you're going to talk to us about how this epidemic has accelerated automation and the impact this will have on future employment. And then you're also going to take some time to over the next few weeks, including today, to explain the history of money so our listeners have a better understanding of our views on the future economic impact of today's monetary and fiscal policy. So take it away, Aaron.
Sure. We continue to progress through our timeline, and we are currently seeing the reopening of states rolled back. I keep wanting to say that differently, but with the new cases, we're seeing some of those states pull back on their reopening. And this may be slowing the industrial rebound we expect for this quarter on this timeline. Now we continue to see those daily new cases rise. And if the sawtooth pattern holds, we expect this following week to make a new high. But again, the rise does not appear, or it does appear to be slowing, which we'll review shortly. Now, we've been reviewing the daily new cases to daily deaths by removing the lag. Until this week, deaths were declining despite new cases. Much of the new cases are likely to due to enhanced testing, but we've seen a small rise in those new deaths, which suggests that the virus is spreading. It's not all about the new tests or the enhanced tests. Similar to the new cases, if the sawtooth pattern holds here, we should see the death count above the recent lows. We look similar to a couple of weeks ago, which would suggest a decrease in the deaths from the previous week. However, we think it's more likely that the last that we're really just going to keep going on this, that it's going to flatten out.
Yeah, so
that we're not going to have over that
widespread between the new cases and deaths.
Right. So we were kind of anticipating 1,000 deaths. Tuesday, that's usually whenever we see that spike, where we're at 935. Now, it's more a psychological difference because 935 versus 1,000, but we didn't cross that threshold despite looking like we would. Now, despite seeing an increase in the death rate, we're looking at the progression of the hotspots. And we can see the virus is spreading, but the spreading is really decreasing. The southern states in Arizona are certainly where the hotspots are, but like the Northeast, it will ultimately subside. We estimate a couple of weeks out before seeing no drop in new cases. Let's see how that forecast proves out. Though most of the attention is on the new cases, the attention should be on the risk. The focus should be on hospitalizations, since this will precede the death rate, and the real risk is the death rate, not new cases, despite what the media wants to push. This slide shows the occupancy rate for all medical issues for each state. We do see elevated occupancy for states that are experiencing a rise in new cases. So we do see some darker purple with Texas, Florida, and some of these southern states, as well as Arizona. However, the average occupancy is usually 65% each year. You can see that in this slide. Remember, the reason for the lockdown was to prevent the healthcare system from being overwhelmed.
Right, that's the key.
Most of the attention is on those new cases, as I pointed out. I think we just, let's see. But that focus should be on the hospitalization, as mentioned before. Now, when we look at the percentage of inpatients for coronavirus, we can see most of the occupancy is for non-COVID related stays, so other reasons. As expected, we do see that higher percentage in areas considered hotspots, but taking California as an example, they have less than 15% of beds occupied by patients that have tested positive for COVID. Why do I say it that way? It's because there are people that are going in for just routine or other procedures, and they're testing everyone. So they may get listed as a COVID patient, but they're not there for COVID reasons, if that makes sense.
Yes.
Currently, the healthcare system is near averages despite these new high case counts. So this information, by the way, is coming directly from the CDC. Due to the increase in new cases, some states, such as California, have decided to really reinstate those closings. This is causing many people to label this as lockdown 2.0. Reading the reactions on this Twitter announcement, the response tends to be negative, but this is certainly not a scientific assessment and could easily be biased. There could be, a right-wing blog that links to this, and all of a sudden there's a lot of people that are making comments on it. But whether this is a popular decision or not, it could still have an impact on the local economy and the broader economy. Many states have paused, slowed, or reversed openings, as we had mentioned. It's still too early to tell if it's casual, but we also see a similar slowdown in GDP growth. What has not slowed is government spending. The rapid rise in spending and a sharp drop in revenue caused the deficit to expand $864 billion in June. Currently, the U.S. is on track to spend $7 trillion this year with an estimated $3 trillion in revenue.
Holy cow, that's a big deficit.
It is. As a comparison, on this day in 2004, the entire U.S. national debt was $7.3 trillion. So we're going to do that this year. The entire U.S. national debt on this day in 1980 was $897 billion. So I bet if you would go to the first of the year, basically what we're going to spend in deficits in June will be spent, was the entire debt load of the country in 1980.
Amazing.
And remember, this is before any new stimulus bills are proposed, which is probably going to happen before Congress adjourns. We're now at $26.5 trillion for a U.S. national debt. We were critical of Cuomo last week, a Democrat. Let's pick on the Republicans. This debt continues to run up despite a Republican president and a Republican Senate. They market themselves as fiscally responsible, but leave a lot to desire in that area. Like last week, a pox on both houses. To be fair, it doesn't matter Republican or Democrat. The Democrats are proposing a higher stimulus package than Republicans, so voting the other party, whichever one, is just not working. Now, based on the current rates, the national debt would be $45 trillion on this day of 2024. It's just 4 years away.
You're starting to talk about some real money when you get the $45 trillion.
Think about that. That would be nearing the end of whoever the next president, it'll be ending their term, and we would have a national debt of $45 trillion based on this level. And we hope the spending slows. Another question should be, where is the government getting this money? As mentioned before, they are monetizing the debt, or a colloquial phrase, printing the money. This is not sustainable, and inflation is likely to be the outcome. The Bureau of Labor Statistics released the latest CPI numbers, speaking of inflation. They came in at 6% or 0.6%. 6% would be a lot. So that's on the last trailing months. And once again, this may seem low, but let's look under the hood of the data, something that we've talked about often on the importance of looking underneath the hood for inflation. Food, home and away. So whether it's the food that you're bringing and eating at your home or the food for takeout that you're bringing and eating at home, was up 4.1 or 5.6% for the last trailing 12 months. Imagine if CPI came in at 4 or 5%. Price of gold would be very, very high today. In June, Energy, all types increased 11.7% month over month, and gasoline was at 12.3%. Now, these are off big sell-offs or big
Right.
drops, but I do consider this a warning. Now, as this with a background, we want to start reviewing the issues with using monetary policy to fill the gap. This is very complex, and to understand the repercussions, we really need to go back to first principles of how an economy works. Let's review a fundamental building block for the economy: money. Aristotle identified 4 characteristics or criteria in money. There are a few others that have been added, but ultimately they're really just derivatives of these same 4 that we're going to go over. Now, ultimately, there is actually no definitive money. Historically, many things have been used as a currency, and it's really always a give and take of these 4 criteria that cause something to be used as a medium of exchange. Money should be durable, portable, divisible, and have intrinsic value. What do I mean by that? Well, let's look at durable. The currency should be durable. Salt is an example of a previous currency. Humankind used salt at one point as currency, but it would lack durability. It would not be lasting. It would have portability. You could easily carry it. It would have divisibility. I mean, you can really get granular with salt, right? And then it would also have intrinsic value. I love to season my food with salt, so there's always some value there. But if you got it wet, your net worth would be pretty much gone. It would not be durable. Portable. Well, barrels of oil would be divisible. You could spread oil out pretty thin, as we've seen with some crises that have happened before, right? It has intrinsic value. There's some purpose that you could use it for. And it's durable. Oil's millions and millions of years old. However, it would fail as a portable currency. You would not want to pay your grocery bill with 55-gallon barrels of oil. And I'm just trying to think of what the register and the warehousing would look like if you were going into the grocery store.
They'd have to have a forklift to go and lift up all those barrels.
We would have to have a forklift to buy your food. Divisible. And now anyone who's read the biblical stories likely noticed wealth was measured in livestock. Livestock is durable, since really you can breed replacements. If it has intrinsic value, since it's life-sustaining, it can be portable, at least in a nomadic world, but I would not want to pay my grocery bills with livestock. But would you need a grocery bill? Anyways, it lacks divisibility. You have serious problems paying with half an animal. And part of that divisibility is that you can put it back together. Technology's come a long way, but I don't think we're that close where we can put the animals back together. The final characteristic is it has value in and of itself. Gold and silver have historically met all 4 criteria. However, it's just a shiny metal, and often we hear criticism, you can't eat it. Well, I'm not sure why eating is the only criteria for value. But my son told me my superpower is eating, so I'm not really sure what that means relative to the gold.
You're a super eater.
I am a super eater. But what use does gold have? But then that begs really another question. What use does paper have? I mean, that's what we have is paper money, right?
And plastic.
And plastic and Bitcoin, right?
Bitcoin.
So the real question becomes, where do things get their value? Often, we get ourselves in circular logic trying to understand value. Adam Smith tried to resolve this paradox. Adam Smith wrote, "The things that which have the greatest value in use have frequently little or no value in exchange. Nothing is more useful than water. A diamond, on the contrary, has scarcely any use value, but a very great quantity of other goods may frequently be had in exchange for it." Smith, often considered the father of economics, tried to resolve this with his labor theory of value. Diamonds take more labor to extract than water. He assumed value is derived from labor inputs. This was a standard belief in not only classical economics, but also Marxism. Marx justified his criticism of the bourgeoisie because they exploited and robbed the labor of profit. This is because he assumed labor is the source of value. However, this theory is incorrect. We only need to change the environment to see a change in value. Let's move from society to the desert. What then becomes more valuable, the diamond or the water? So if it was the
Water in
labor,
a bottle.
that's right. If it was labor input, the value should not have changed, right? Because it took the same amount of time to extract the diamond and the water, whether in the desert or not. I believe Marx stopped writing about economics when he noticed that the textile industry was reducing the labor needed to produce textiles. But here's the key, the profit margin was increasing for that industry. If labor was the source of exploitation, we should see a decline in profit as you lower the labor inputs. No, value comes from somewhere else. Now, we will continue the discussion next week with marginal utility and regression theorem, I know they're large words, and review the history of money up to the current, to include Bitcoin.
I hope I can even remember what those words are.
You won't have to. The ultimate purpose, though, is to understand how we approach investing in the current monetary environment. No change in our themes, but I wanted to spend a little time on our favor U.S. domestic equity. We are concerned about U.S. monetary and fiscal policy and recognize the current environment is just a mess. Now, why favor the U.S.? One reason would be the cleanest dirty shirt in the closet.
We've used that.
We've been using that
before.
since 2008. At some point, we hope that investments are great because they're great investments, not just because it's the only alternative. So another more concrete reason is the change in risk appetite for the extended global supply chains. Much of the exported jobs were manufacturing jobs because of low labor costs in other countries. However, the risk of supply chain disruptions is causing many companies to rethink offshoring as a cost-saving strategy. We are seeing automation come online in the hospitality sector as well as the meatpacking sector. Notice both of these sectors have been hit hard by the current pandemic. The virus is expediting the use of automation. An oddity is that the meatpacking is currently being done better by humans than what robots can do. Also, you would think that the automation would tend to be done in higher labor cost environments, all other things being equal. Currently, the focus is on high risk areas due to shutdown. So if we look at this slide, we can see that animal slaughter and processing is actually a lower labor cost, but when we look at the amount of employees per 1,000 square feet, that's the reason that we're looking for these, or that we're seeing some automation here. So why favor the U.S.? It's much easier to add manufacturing back into the country than other countries, really, to be able to catch up on that technological know-how. The U.S. exported these jobs because it's easy to do elsewhere at lower labor costs. With automation, we're going to see lower labor costs to manufacturers here domestically. Now, we hope later to spend some time on what this means to lower skilled labor going forward, or at least the labor that is easily can be automated, because there's going to be problems with the labor market if a lot of people are getting excluded due to this automation.
Right, what would they do otherwise?
Right.
That's the transferring of the skills.
So this is one of the reasons that we favor U.S. domestic, but it's also to remember the virus is only accelerating this phenomena. Since 2016, populism has been on the rise in the U.S. and abroad. It's happening in Europe and elsewhere. It also does not matter what party, Republican or Democrat. President Trump has campaigned heavily against globalism. That's what his whole 2016 campaign was about. However, Senator Biden's economic policy platform resembles President Trump's when it comes to foreign trade. Taxes are different, But when it comes to this aspect of foreign trade, Biden and Trump look similar. Really what's going on, there's a deeper shift, and it's not specific to any one country or party. We, therefore, consider this a long-term trend. Now, we're nearing our time, so I wanted to run through a couple more slides. The 50-day moving average has crossed the 200-day moving average, that golden cross that we've talked about over the last couple of weeks. And it's not likely a coincidence that we're up, at least in this morning, we had some very strong markets. I know there was
still up at the
some
end of the
positive
day.
news about vaccines and
Right.
other things, but we think this technical indicator is another reason why we're still seeing this march up the wall of worry. We continue to hold and overweight the U.S. domestic equities relative to the benchmark, and we're watching the dollar due to this U.S. overweight because that could offset some of the advantage of being overly invested in the U.S. if the U.S. dollar is starting to lose some value in global markets. Now, with these high valuations, and they are high, and a weakening dollar, we're watching emerging markets, because the value is not an international, whether Europe or Japan, to see if there's a new tilt that we should add to help offset some of these risks. But as of now, the U.S. is holding up well. That's especially true today, and it's been the place to be. So John, I want to turn it over to you for question and answer.
Well, so let's talk about inflation and interest rates. You know, most people equate inflation to higher prices and simultaneously rising interest rates. So we keep talking about inflation as a key financial planning risk because of the amount of monetary and fiscal policy that's being pumped into the economy. Yet, how can we explain this going forward? You know, so we can see a potential for interest rates being low for a long
Right.
period of time, because the government really can't just raise rates, or they'll not have the capacity to pay back on those loans that they have. So what would this mean in terms of financial planning, in terms of what would we be doing for one to either grow or preserve their wealth with these different?
So the first question I'll ask is inflation and low yield.
Yeah.
So one of the things that we want to explain over these next few weeks is inflation is the increase in the money supply. We often think of as inflation as a rise in consumer price index. They do correlate. If you increase the money supply, you often do see a rise in prices on consumer goods. But it doesn't always happen. 2008 was an example where we increased the money supply tremendously, but we didn't see, at least as expected, the price of goods go up as much as the money supply. So with the Fed, they are increasing the money supply, or they're inflating the money supply. But what are they doing with that money? They're going out and they're buying bonds. Why are they buying bonds? To keep interest rates low. So you have the Fed inflating the money supply to then go buy bonds to keep interest rates low. And they're doing that because we looked at those numbers, $26.5 trillion. The debt is unsustainable based on the current market. They're trying to inflate it away. They're trying to keep bonds paying a yield less than the current inflation. And we think...
So won't that then limit the number of tools that they have? Because one of the tools they would have in managing economic situations is the ability to raise rates. So if they can't really raise rates, where does that leave the Fed?
Well, they have invented a lot more tools. If you go prior to 2008, they definitely have more tools. And this is one of the things that we want to get. It's just going to take a while to explain the whole process and why we started with money and what money is. We're going to move into how that flows through the system to ultimately better explain those tools. The Fed can keep interest rates down because they have an infinite balance sheet. And they're going to continue to do that because that's the only game they have, is to try to make the debt lower through inflation. And they're going to do that. Now, what repercussions does that have over the long term? Well, one of the reasons that we have said that we favor equities over fixed income is because you're not getting a real rate of return on the fixed income. They have their place in the portfolio, mainly to try to lower that volatility if we do have sell-offs. And we're going to have sell-offs. But as in providing value and being able to meet those future income needs, we are wanting to lean further into equities because of that inflation risk.
So I definitely think that we're seeing inflation, because even my daughter, who lives in Washington D.C., was telling me that every week she goes to buy groceries, she buys the same thing every week. So what 1 month ago would cost her $100 is now costing her $140.
Right.
I think we're now seeing that in the restaurants as they're reopening up too, is that prices are definitely higher.
Well, and as they open up, they have a 25% cap on how many people can be seated there. And restaurants are a low margin game. And they usually only make money on a couple of tables an hour because of the fixed cost being so high and the competition being so high. So I would expect, if you're going to be dining in, to see substantial increases for restaurants. Now, they're going to try to offset that by having takeout. So it'll help cushion some of that blow. But I expect to see, and we are seeing, we had warned before that, and the reason that we're looking underneath the hood at the numbers is the things that we're buying, groceries, clothing, things that are at home, those are moving up in a big way. And at some point, all the other items in the basket at least become flat, if not begin to move up themselves. Yeah. And then that's when we're going to see the CPI number start to move up.
Now, you had talked about how client portfolios have built a meaningful outperformance cushion this year relative to their benchmarks. Is there something they should be doing to preserve this lead? For example, should they move more money to cash? Should they move to a more conservative allocation? What do you recommend?
Well, as mentioned, we do see that the valuations are stretched, especially in technology. There's been a big run towards these companies. One, because they continue to make revenue. They actually have an increased revenue because of the lockdowns. There's also ways that you calculate the value of the stock that in a lower interest rate environment benefit stocks that are like technology stocks. So we're very cautious about that, but once again, with inflation being what we see is the long-term risk, we think it would be not prudent to stay invested in equities and try to go to cash, because if the market was to sell off, and it's certainly possible here, the Fed is going to act. They want to continue to keep those prices up. So you're just going to have to pay for some volatility, because over the long term, cash isn't earning anything. Inflation, even if it somehow was to stay low, is losing money. But if it does move to that 3 or 5%, which I don't think is, I think that is certainly a possibility, you're going to lose tremendous value. One of the things we've said often, and it's not that we came up with it, but we repeat it, is more money has been lost sitting on the sidelines expecting a pullback than has been lost just riding out the volatility. But what do you do then if you do have a sell-off? Well, that's the importance of cash up. So we're not saying not to have any cash. We're also not saying not to have any fixed income. We're just saying you need to be invested in this market and you need to stay in. And also, that big cushion that we have was us following our technicals and our signals. We have faith in them. They've proven out and given us a lot of cushion. And right now they're saying stay invested in these areas. We are beginning to pull some of that gain back out and try to be a little bit more diversified instead of so concentrated. A lot of the concentration is because we did well and those assets really outperformed all the others. But it is something that we are very aware of, kind of keeps us up at night paying attention about it, but we watch it thoroughly. And are looking at alternatives if we need to make those changes.
That reminds me, I never worry about the market. You know why?
Because I don't sleep at night. Because
you don't sleep, and you and the investment committee worry. So why should I worry if you're worrying? So it seems that people are settling in with COVID and learning how to live with it. Even I have this habit now. Whenever I walk out the door, I yank out my mask. So how do you foresee acceptance or this learning to live with it to manifest itself in the way we work and live in the future? And what impact can we expect of the market from this change?
So People are definitely better in the environment than they were March and April. How long they can do it, it's certainly having a psychological impact. I've actually seen, I'm going to put air quotes around research because I don't know that it's that I would make tilts to the portfolio based on this, but there are people that have speculated that the deaths because of the lower poverty rate globally, because of the economic shutdown, because of the psychological impact that the not being employed and just the constraints that people are not used to. Some have speculated it could be 29 times the amount of death from the shutdowns versus just what would happen for the virus. Once again, I'm putting air quotes around that,
Right.
that research because I think that's the most extreme that I've seen. It's probably not nearly as rough as that. But one thing that you can say about humans is that we're very robust. We adapt, improvise, and overcome. And to the example that we were just talking about, go back to March, go back to April on how shell-shocked we all were trying to operate during this time. We have new cases that are higher than they were in March and April. Thankfully, we don't have the death rates that we have in March and April, yet we're starting to figure out how to survive and some even thrive in this current environment. So,
Right, and sometimes we forget how we've actually survived incredible catastrophes. Think about, even in the Civil War, we lost 620,000 people, which today would be over 6 million. I mean, imagine if that happened today.
Right.
But somehow we survived. We survived World War I, World War II. We survived the Spanish flu.
So the Spanish flu, the coronavirus we know is real. We've seen the deaths. It's definitely higher. It's at least somewhere around a very bad flu, and that we don't even know what impact the shutdown has and how much that has lessened or impacted that. But it's nothing compared to a cholera outbreak. Our great grandparents certainly had survived more difficult environments than what we are going through today. So you just can't knock human their ability to
Resilience,
adapt,
yeah.
their resilience. Also, just this country, we have a knack for being a phoenix that rises out of the ashes. So who knows what we're going to look like through this? Do we have a lot of problems? Yes, but as you said, we've gone through civil wars, we've gone through revolutionary wars, we've gone through the Spanish flu, we've gone through Great Depression, we've gone through a lot, and we somehow each time come out stronger as a nation.
That's amazing. But so one of the things you mentioned, which is kind of interesting, is that because it goes contrary to what one of our guest speakers commented on a few quarters ago. He said that the poverty globally is actually increasing, where a speaker several quarters ago was talking about how every second 5 to 7 people are moving to the middle class. What's the shift?
So the shift is the lockdowns. Right? We're doing an experiment globally where we're shutting down the economy. We have never done that before. A few quarters ago, that was true. You had poverty rates continually to decline, and they have since the 90s. Think of how many people have come out of after the fall of the Berlin Wall, the Soviet Union revolution, the modernization of China. You had hundreds of millions of people coming out of a pure communist system into a more capitalist system and rising incomes. Now, granted, if you look at compared to what the U.S. considers poverty rate, there's still a lot to go. And if that 29 times death rate, it's mainly going to be outside of the U.S. in areas that they're at that subsistence level. So up until this point, we have been growing people out of poverty through globalism. What does this populism mean for the countries that are not nearly as developed as the U.S.? What does shutting down the economy look for the people that are really at the margin? It certainly hurt them through this this shutdown.
So we often talk about this idea of having a 24-month cash buffer for clients in retirement who are receiving monthly distributions from their investments. Can you talk about what we recommend to clients in the accumulation phase of their lives? In other words, what do you recommend regarding emergency fund reserve targets for families with either a single breadwinner, and how would this be different when there are 2 breadwinners in a family?
So it does differ. If you have two people that are professional making good incomes, the risk of both of them losing employment and not being able to bridge the gap in a short-term unemployment situation until somebody picks up another job is going to be lower. So the need to have more cash set aside, because the whole point of cash is so you don't have to liquidate your investments. So if the risk of needing to liquidate your investments is lower, then the amount of cash buffer that you need to offset that risk would also be lower. If you are in a head of household where there's just one breadwinner, one maybe stays home and with the children, and let's say that person also runs a business where they can go months without any income. Well, that person is probably going to need near what a retired person would need for income, because they may need to sustain themselves off of savings for a lot longer while they wait for their income to catch up. So it really is just how long could you be unemployed and not receive income? And if you have two people working, the risk of both of them being unemployed at the same time and being able to get gainful employment is lower. If you have a single person, obviously that risk is higher. You could go longer. And then if you have a business that you could fund, and oftentimes you're the first person to take a pay cut and not get paid, well, then that would expand it. So it really just depends on each person's unique situation. Lead advisors are well equipped to help make those decisions and go back and forth with the different risks.
So let's talk about the financial sector. You know, banks typically make money on the spread between what they pay on cash and what they earn on interest from loaning out the cash. Well, low interest rates make it more challenging to have larger spreads, or spreads closer to historic averages. How do you think the low interest rate environment will impact the banking and financial sector in the years ahead?
Well, so it's all about the spread, what they need to pay depositors and what they can earn by loaning that money out. And as long as it's positive, they can continue to make money. Now, with the recent crisis, there's no longer any required reserves. So they could expand or loan out an infinite amount of money. So if you could only make one penny, but you can do $1 million or 1 million loans, you can actually increase your revenue. And that's one of the reasons that we're concerned about how fast the money supply could be expanded. There really isn't a break. So it's about that spread where the banks make. Now, another thing is, with the refinancing, it's not just spreads that banks are making money. A lot of times, let's say the mortgage industry, they package a loan and then they sell it off. So they're never going to make money off interest rates. They don't care about where the interest rate is. They're going to make it about, they're going to make money on originating loans. And then let's talk about the PPP loan. I've seen somewhere between 18 and $20 billion as the initial number in origination fees that the banking industry was able to collect from processing the loans. They never provided the capital. That was all provided by the government. They were not at risk. They just did the application and the underwriting and made $18 billion. So
it sounds like even if you have a lower spread, banks could be making money in other ways through transaction fees or those types of things.
Origination fees, transaction fees. Don't run your checking account lean and all of a sudden have a few transactions go below your value, because it's no longer just a $10 or $15 charge.
That's the NSF that appears on your statement, right? Either online or in paper, non-sufficient funds. Hey, so last week you were talking about the silly season.
Yes, still in.
It's silly. There wasn't quite as much silliness this week, but by this we're referring to the silliness that oftentimes comes out of political campaigning from the candidates running for office.
Yes.
You know, each side lambasting the other, often fatiguing the average citizen over the constant negative messaging. So how do you see this heating up, and what type of market response would you expect as voter polls show either candidate ahead or behind?
Well, I mean, how relevant are the polls? In 2016, I think the betting markets had Hillary Clinton at a 98% likeliness of winning the election.
Brexit was not supposed to happen either.
Brexit was not supposed to happen. It's just
we even had a special call to our listeners after that.
And I just saw a recent poll where Whether this it's not been proven to be an accurate catch, but they asked people whether they would vote for Trump or not, and they said no. Biden was outpolling Trump by a large margin in this poll. But they had a follow-up question: is how do you think there are any secret Trump voters as neighbors that are going to vote? And it was about 57% said yes, they believe that there were secret Trump voters as neighbors. And the poller, what they're trying to do is they believe that somebody may lie to them that they're going to vote Trump, but if they are lying to them, they're more likely to say, yes, I do believe there are secret Trump pollers, with the thought that person is the secret Trump poller. Who knows if this is right or not? I think we're about 110 days out from the election, and a lot of it has really been postponed. I think we forget how close we are. At some point, we're going to have some debates, and I think that's whenever we'll have a better idea. Another anecdotal component that we try to pay attention to is the number of yard signs that we see, because there is this, seems to be people that will vote for Trump will not openly say that they're going to vote for Trump. So there's that secret Trump voter. People that would vote for Biden are likely to have a yard sign. So if we don't see a lot of Biden yard signs, is that anecdotal evidence that there may actually be a lot of Trump voters? Remember, 2016 had Hillary Clinton winning. We have no idea, and we're trying to figure it out. But the one thing that we can, that we feel is that the polls, whether Brexit or the previous election, they just don't seem to be able to give us a really good picture of what's going on.
Yeah, I think that one of the lessons here is that we aren't going to make a decision on the investment portfolios because of polling.
Right.
What we want to do is to be prepared for whatever outcome that it is. How should our portfolios be positioned? I think that's the type of confidence that our clients want to know.
And there are likely people that have figured out a clever way of assessing a closer probability that is better capturing it than just the phone calls. And if that's the case, they will make bets within the market, and our technicals will pick up that there's money flowing, and it seems to be a confidence component. So we may actually have a hint, depending on what sectors are moving well, relative to who's actually really doing better on the polls.
By the way, one last question.
Sure.
I had a question that came in from a listener. He wanted to know, since inflation is the biggest risk that we face long term, what would you think is the best hedge for inflation?
I want to say that gold and silver have tended to do the best in an inflationary environment. But that doesn't mean that you go out and you spend a lot, or you allocate a lot of your portfolio to gold or silver.
Like Rand Paul, he puts all of his net worth into gold and silver.
Ron Paul probably.
Ron Paul.
So we think it's a broader mix of equities and some precious metals, and just being diligent, maybe some commodities at certain times. And the reason is during the 1920s, we had what I think is a very similar environment, where you had the ability to expand the money supply substantially, but not see prices increase on goods, because you had the car, you had all these new appliances, you had the telephone. There was all these new innovations keeping the price of consumer goods down to offset what was happening underneath in the banking system. And I think we're similar to that. We have the internet and all the innovation that's coming there. We have hundreds of millions, if not billions of people coming out of coming into the market economy to help keep labor costs down. We have fracking that helped keep energy prices down. There was a lot there. So that inflation may not just be, you may not see it in the price and you won't see it in gold. And the other thing is, in the 1930s, after the collapse, where it would have been good to have a lot of gold, it did move up after the Depression. The government outlawed it as an individual to own it. So there's precedent of being right and having that right bet or right trade confiscated through legislation. So,
Yeah,
always, don't put all your eggs in one basket, right?
Yeah, and so we're going to be talking about this in the weeks to come, because these are some of the things that the investment committee is looking into. So it looks like we're out of time today, but so over the next few weeks, as I mentioned earlier, Aaron is going to continue to educate our listeners on the history of money, and this is important to learn in order to better understand our philosophy around financial planning and investment management, organized in a way to grow and preserve wealth both now and in the future. Our investment committee is also working on some exciting projects such as portfolio insurance.
Yes, bonds will not play that role.
Ideas on how to organize one's assets to prepare for the time when government debt reaches potentially unsustainable levels. Things like gold and silver, how does that fit into total plan? So we want our clients to be confident that their financial plans can weather all seasons.
Yes.
So we had planned a special guest to explain the PPP loan forgiveness program and what to expect from banks as the SBA loan forgiveness application process rolls out. Not surprisingly, though, the rules keep changing. And based upon new guidance, the SBA will not require documentation for loans below $150,000. Rather, employers will only need to attest to having used the funds according to the rules outlined. So that's kind of interesting. So I want to remind our listeners that discussions around any specific stock or mutual fund is not an endorsement to buy or sell, but simply commentary based upon each commentator's opinion. All investments have risks. Past performance is not indicative of future result. That being said, I also want to remind everybody that these weekly broadcasts are open to the public. We welcome the opportunity for you to share the links to our broadcasts on social media or with your friends and family, as they are more than welcome to listen and learn our perspective on the market and the economy. So thanks again for listening in to today's broadcast, and as always, if you have any questions, please contact your lead advisor or any other member of our team. We are here for you. So long for now.